Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Risk assets tumble as Donald Trump threatens more tariffs on China and confirms levies for Canada and Mexico will go ahead from Tuesday. Beijing says it will take, quote, all necessary countermeasures to defend itself. Meeting the UK Prime Minister, President Trump says Britain could avoid tariffs if a deal is reached on trade, saying officials are already working on negotiations. Plus, Donald Trump backtracks on calling Ukraine's president a dictator ahead of today's White House meeting with Volodymyr Zelenskiy. As well as the geopolitics, earnings also in focus with the chemicals giant BASF, listed, of course, in Germany, but with that global exposure coming through with a line for 2025 adjusted earnings, EBITDA. They're seeing between 8 to 8.4 billion euros. The estimates had been for 8.39 billion euros, so roughly in line with the estimates in terms of expectations around earnings for BASF. We know, of course, there's a big focus on the China part of the story there and also their Yortos unit, which is high margin for that company. The stock is up about 14 to 15% in the last 12 months. Let's get to the broader markets right now because we are seeing a rout across these risk assets pronounced in Asia and the ripple across to Europe as well. Tariff angst certainly at the fore, and the tech companies stateside yesterday plummeting. Nvidia down 8.5% by the end of the session, and you saw the Nasdaq 100 falling 2.7%. The S&P closed lower by 1.6%. So it's a brutal handoff for Europe as we square up to Friday's open at 8 a.m. UK time. Currently, European futures looking to lose about 1.1%. FTSE 100 futures here in the UK looking to drop about 52 points, down 0.6%. S&P futures stateside currently flat after the losses of yesterday. A bit of a pause, bit of a breather when it comes to the futures space in the US after the rout of yesterday. Nasdaq 100 futures, though, pointing to modest gains of just 13 points. Let's flip the board and have a look cross-asset because the move into treasuries is still there. The rally for treasuries continues. 422 right now on your benchmark US 10-year. You are looking at yields on that 10-year back to levels we have not seen since December of 2024. Today, yields lower by 3 basis points. Euro dollar back below 104 at 103, currently down 0.1%. Bitcoin has tumbled about 25% from its record highs, currently just above the 80,000 level. Is there resistance at 70? Remains a question. Brent at 73.68. The commodity space is being squeezed again by the tariff risk today, under pressure, and oil down 0.5%. Let's cross over right now to Singapore. Avril Hong standing by for a check on the Asian markets. And my goodness, it's a rough ride this Friday.
Oh, it is rough. It is wild. We're seeing a lot of repricing underway, selling pressure across the board. Asia's stock gauge is headed for its first weekly loss in 7. I'll go throw more superlatives at you in just a bit, but note here, it is also the chips that are the drag. Nvidia earnings continuing to sap sentiment, but the big driver, of course, is Trump's tariff talk. The worry now is that this turns into an all-out trade war. We're watching out for China in terms of retaliatory action. Bloomberg intelligence of the view that so far they've been more measured in their approach. Does what Trump just says turn things up a notch, kick things up a notch? So we're seeing the Nikkei lowest level since September, and the region's benchmark, along with the Hang Seng Tech, the gauge of Chinese tech stocks, headed for their first weekly loss in 7. Keep that in mind. Flip the board again because the selling is not confined to equities. We're seeing that in FX as well, not just because of the dollar bounce, but for many of these EM Asian economies, the worries that they themselves could be hit by tariffs. Indonesian rupiah today hitting the lowest level against the greenback in 5 years. Really interesting how the renminbi has managed to keep its head above water, and some of this has to do with the PBOC's signals via the yuan fix today that for the past month or so has been at around the 717 level. So clearly here, even in the face of challenges from Trump, they want yuan stability. Flip the board again, because the Chinese tech stock losses has dented the thesis on US-China tech decoupling for today at least. MLive's Mark Cranfield says the key test is going to be the performance of the Golden Dragon later today. If it enters the weekend with modest losses, then maybe this is a signal that Chinese tech stocks can continue outperforming in the region. Tom.
Yeah, and will the stimulus coming through from Beijing, or at least expected additional stimulus, do enough to support this economy in the face of those additional tariff threats? Avril Hong in Singapore with a great check on the markets there on a challenging day once again for Asia as we come to the end of this week and the end of this month, of course. Now, the global market sell-off is being driven by the US after Nvidia's underwhelming results. That was certainly a factor, and President Trump's latest tariff comments. For more, let's bring in Bloomberg's Valerie Teitel for a broader look at the global market rout that we've seen. Valerie, what stands out to you?
It was a swift plummet from U.S. equities into the close yesterday. The S&P 500 totally wiping out its gains for 2025. And in the last week, the S&P 500 has now dropped over 4%, Tom. It was also a weak session for those tech indices, driven by the drop in NVIDIA. If we flip on, it was a surprising late session move also from NVIDIA, having its worst session since the DeepSeek rout in early January. Now, the Magnificent Seven is not looking so magnificent this year. 6 out of those 7 stocks are in the red year to date. Only Meta is clinging on to small gains. Also, the Bloomberg Dollar Index saw one of its biggest jumps in 2 weeks. Again, this is on ratcheting up on Trump's tariffs threats. He is very much lasering in on that March 4th date. That is only 2 sessions away for the markets. The Bloomberg Dollar Index did see quite a stark jump. Now, we have some data dropping later today, Tom. It could add some fuel to this fire. We have the U.S. PCE data, the Fed's favored inflation metric, expected to rise month on month for the month of January. We're going to be analyzing even the second decimal of this month-on-month print. If there's any hint of a hot inflation backdrop to this print, we could expect to see the equity market end in the red for the week.
OK, you're going to have your magnifying glass out for the data later today on the inflation front, with markets pricing in right now a little over 2 additional cuts this year. We'll see how that adjusts around the PCE, of course. Valerie Teitel with a check on the market reaction. And it has, of course, as Val was saying, been pronounced. Valerie, thank you. Part of this, of course, is down to what's happening on the tariff story. Chinese stocks sliding, of course, in the session. We've touched on that with Avril after US President Donald Trump said he would impose additional 10% tariffs on imports from the world's second largest economy, adding to fears, of course, of an expanding trade war between the two nations. Beijing has vowed to impose all necessary countermeasures. It comes after Trump said the 25% tariffs on Canada and Mexico are on track to take effect next week. Here's what he said when asked about countries that call tariff policy inflationary.
It's a myth that's put out there by foreign countries that really don't like paying tariffs, and especially to even up. So we've been treated badly by a lot. We're using tariffs. And I find, and you just have to look at the numbers, but I find that it's not about inflation. It's about fairness. And the inflation for us has not existed. And I don't think it's going to exist.
OK, for more, let's bring in Bloomberg's Bill Ferry. So Trump once again pushing against the tariffs are inflationary narrative. What do we know at this stage, Bill? To what extent do we have clarity on to whether or not this is a negotiating tactic that will essentially be solved at the last minute before that deadline of March the 4th, or if this is a structural change in trade flows that this administration is pushing for?
Well, it's honestly been a sea of confusion over the last week as President Trump talked about the various different tariffs and when they'll come into play. He's tried to give a little bit of clarity on that, saying, as you mentioned, the Mexico and Canada 25% tariffs coming in on Tuesday with the 10% tariffs. It may very well be a negotiating tactic, and if it is, we're not going to probably find out till some point on Monday in the U.S. hours. We're just going to probably have to wait and see. We saw that happen just about a month ago when those Mexican and Canadian tariffs were supposed to initially come in. And at the last minute, Trump said that he had had some promises about work to seal the border, the northern border and the southern border, to go after illegal immigration and fentanyl imports. So is something like that in the cards at this point? Possibly. And with China, is he pushing for something there that could happen at the last minute? Does he want a call from Xi Jinping? Is there some other leverage he's seeking? That's going to be something I think we're all going to have to spend the weekend worrying about and wake up Monday hoping to learn.
Yeah, and for now, of course, the markets are not taking any chances on this. To the broader geopolitical question then, in terms of Ukraine, Russia and that potential ceasefire, Ukrainian President Volodymyr Zelenskiy, of course, visiting the White House today. That is certainly going to be something to watch. In his meeting with the UK's Prime Minister, the US leader walked back, meanwhile, Trump walked back his denunciation of the Ukrainian counterpart, of his Ukrainian counterpart last week. Take a listen.
Mr. President, do you still think that Mr. Zelensky is a dictator?
Did I say that? I can't believe I said that. Next question.
Bill, what should we expect then from this meeting between the two presidents of Ukraine and the US later today?
I think we're going to be watching a lot of the body language in addition to what the two leaders are actually saying to each other. It was just a week ago that President Trump did in fact call Zelensky a dictator and said he had a 4% approval rating, despite polls showing otherwise. And President Zelensky saying that President Trump was living in a disinformation space. So things got really ugly last week. They're trying to repair that. I think we don't have a lot of the details about what this minerals agreement will include. We don't think it's going to include a security agreement or security shield for Ukraine. But I think the most important thing here for Ukraine is that President Zelensky is doing this in person with Donald Trump. And I think given how fast Trump says talks are going with Russia, this at least keeps Ukraine somewhat near the table, if not at the table, as those discussions proceed.
Yeah, as you say, watching the body language is going to be fascinating, isn't it, in terms of that meeting. We saw some body language at play as well in terms of the meeting between the UK Prime Minister, Keir Starmer, of course, and the President. Arguably he left that meeting with Donald Trump with a little bit to be satisfied about, the UK Prime Minister, despite falling short of his key goal of trying to secure that US military backstop to protect Ukraine. The US President also said he would restart long-stalled negotiations on trade with the UK. Let's listen in.
We're going to have a great trade agreement. One way or the other, we're going to end up with a very good trade agreement for both countries. And we're working on that as we speak. I think we'll have the confines. I think we'll have something maybe even in terms of possibilities agreed to very shortly.
Our trading relationship is not just strong, it's fair, balanced and reciprocal.
Bill, someone characterised this as arguably the most important meeting between the UK Prime Minister and the US President in years, possibly decades. What did you make of this meeting? Did Keir Starmer handle the President deftly, or did he miss an opportunity on Ukraine's security pledges?
Well, I don't know that anyone could have convinced Donald Trump to make a security pledge to Ukraine at this point. This was a huge meeting for the UK Prime Minister, their first meeting. He has been courting Donald Trump at least going back to just the hours or the day after that first attempted assassination attempt on Donald Trump. It does go to show you don't have to be in the very conservative or right-leaning camp to win over Donald Trump. Keir Starmer, in this case, having a big incentive for Donald Trump to get along. He's got that promise of a state dinner, a state visit with the king to put out there. We know that Donald Trump has a special place in his heart for the UK, and Keir Starmer really milking it, saying that invitation, that second invitation, was unprecedented, something that just never happens, and a sign of just how strong that relationship is. But when you go back to that trade deal that he seemed to get some positive news on, you got to remember that in 2017, when Donald Trump took office the first time, he said the UK would be at the front of the line for any trade deal after the UK had settled its departure from the European Union. So he had a whole first term. That didn't happen. So there's going to be taking those comments with a little bit of a grain of salt going forward. But it is, if you're looking for good news, I think Keir Starmer got almost as much as he probably realistically could have hoped for on this trip.
OK, Bill Ferry's excellent roundup of the key lines, of course, when it comes to Ukraine, the UK Prime Minister's visit, of course, and Trump's latest comments on tariffs, Bill. Thank you. We appreciate it. Let's get back to the earnings story. Allianz, of course, the insurer, but also the asset manager, home, of course, to PIMCO, coming through with a beat in the full year. Operating profit of 16.02 billion euros, so just above 16 billion euros for the full year operating profit, above the estimates, which had been for 15.8 billion. So a modest beat full year. In terms of the outlook for 2025, they say operating profit of between 15 and 17 billion euros. So at the high end of that range, above the estimates. So that is also a positive. And in terms of inflows into PIMCO, we know that's important as well. Third-party net inflows for PIMCO in the fourth quarter, 14 billion euros. Of course, the company also announced a ramp up in its buyback programme. That was announced yesterday, potentially as much as 2 billion euros. Stocks to watch for you, of course, at 8 a.m. UK time this Friday. Coming up, market sell-off, of course, as the chips are down for Asian equities and tariff talks sap sentiment. We're going to discuss with Tatjana Greil-Castro from Muzinich and Co. How to position, particularly in the credit markets and fixed income. That conversation coming up. This is Bloomberg. Welcome back. Happy Friday. European futures and Asian equities not very happy right now, following Wall Street lower, driven by Nvidia's underwhelming results. Sentiment being further sapped by Trump's latest comments on tariffs. For more on the global market sell-off, with a particular lens on the sovereign space and fixed income, let's bring in Tatjana Greil-Castro, Public Markets Co-Global Head of Muzinich and Co. Tatjana, good morning. Thanks for joining us. Let's talk about the bond market, and we'll start on US Treasuries, where, of course, we've seen a rally in Treasuries. Yields lower by about 60 basis points on the US 10-year since around the middle of January. Do you lean into that trade? Is there further to go in terms of this US Treasury rally?
Good morning, Tom. Good to see you. In terms of the Treasury rally, that has performed really well indeed, also because it came from a very high point, right? So we went up to 4.8 roughly. And so it did have a long way to come down. If you think late last year, it was, in the second half last year, it came down to about 3.5%, which was the lowest. So we do think it will trade in a range. This is now probably the lower part of the range, the mid to lower part of the range, and where we can go, depending on, we have so much to unpack, right? So there's this expectation that, there is signs that inflation is actually rebounding. So inflation coming back up. So clearly that would be bad for the Treasury market and for fixed income. But then also what impact to all the changes that Trump is currently initiating? There is a lot of unraveling. So what does that mean to the overall market sentiments? And clearly if market sentiments are poor, then people are flocking to the Treasury market. So there are so many competing forces at the moment, and so that's why we think actually that the Treasury market will trade in a range, not really breaking out that much either way, but it can still be, feeling it. Let's put it that way. It's becoming quite a good hedge to the equity market, which it wasn't for a while, but now the negative correlation, I think, is starting to kick in. So if you look at your overall portfolio, the Treasury market or fixed income has a room to play again.
Okay, maybe the 60-40 strategy is back. What happened to the tariffs are inflationary narrative and therefore negative for bonds story? Has that just been counteracted by the safe haven moves that you're discussing there?
Exactly. So to the extent that tariffs may reduce or put the wedge in trading, and so clearly that you would assume that means first clearly it makes everything more expensive, right? Just because of the tariffs, things are becoming more expensive, but also there will be increased trade frictions, and so because things become more expensive. And, even if it is just 0.5% all in, because when you calculate it over the overall inflation, depending on how big the tariffs are and which products are being affected by it, the estimates that it could be between 0.3 and 1%. So that could become quite meaningful. but then also the trade frictions that are being created could mean that there is lower growth. And so you have those two opposing forces where it is very difficult to see where it comes out on the fixed income market. It's probably easier to see where it comes out on the equity market. And it doesn't really spell for a strong equity market. And that's something that we have been discussing probably for the last 2-3 months, where we're saying, given the performance of the equity market and the valuations of the equity market, particularly US valuations, we are cautious to see similar returns that what we have sort of gained over the last 2 years. And so if we are lowering our return expectations to more normal return expectations, then given the yield levels that we are seeing still in the US, plus the credit spreads, credit becomes quite interesting, because you have similar return sort of yield expectations in terms of dividend yields versus the yields that you're getting in credit, but clearly you expect much less volatility in the credit market. And when you go to the short end, much more predictability of your returns.
OK, Tatjana, unfortunately, we've run out of time. Trump and the news flow has squeezed us somewhat, but we appreciate your insights, as ever, on the sovereign debt markets, of course, and a view on credit and the interlinkages with equities. Tatjana Greil-Castro, co-head of public markets at Muzinich, thank you. Coming up, we're going to take a closer look at whether Donald Trump's steel and aluminium tariffs will create the domestic boost the president promised. That's coming up. This is Bloomberg. Welcome back. Donald Trump says he will impose US tariffs on imports of steel and aluminium as part of his efforts to re-engineer global trade and create jobs at home. Here to analyse what this means for American and foreign steelmakers is Kwasi Ampofo, who is head of Bloomberg NEF's metals team. Kwasi, so Donald Trump is pledging that this is going to benefit the US economy. How dependent, though, is the US on imports of steel products at this point?
So, I mean, at the moment, President Trump was planning to impose tariffs on steel and aluminum. Last year, the US imported $90 billion worth of steel. And
that's not a small amount, 90 billion.
Not a small amount, exactly. So if you ask me how dependent the US is on other markets, I'll say quite a lot.
OK, quite a lot. In terms of whether or not this is actually going to benefit domestic producers, that is the rationale of the Trump administration. What is the evidence to support that, if there is any?
No, I mean, at the moment, the utilization for most of the US steel mills last year was about 76%. So I think there's still room for them to sort of grow to meet that domestic demand. However, for them to do that, to pretty much substitute all imports with domestic production, that would mean that in the next 2 years, they would have to be operating at about 90% utilization. Mm-hmm. And Tom, look, there are some of these steel mills that are 100 years old. So trying to push something 100 years old to 90% utilization is quite high. I think in the near term, obviously, we're going to see a response from these domestic producers. But then in the long term, as to whether they can fully substitute imports, it's going to be quite difficult. With
that increase in production, then, so you're talking about 76% capacity right now. They can get it. They could get it, or they would need to get it to 90%. How does that map onto the jobs market then? Yeah, so that's quite an interesting one. So the evidence is still quite unclear. I mean, for those who are quite familiar, so this is actually a resumption of Section 232. So back in 2018, President Trump enforced a similar measure where he put restrictions or import restrictions on steel and aluminum. And what happened then in 2018 was that we had only 2019 as a full year to determine the impact on jobs. It was just 4%, Tom. Unfortunately, COVID happened in 2020, so we are unsure whether we're unsure the full impact of what happened. But then back when he did it, it was just 4% of jobs. OK, that's really important context and analysis. Kwasi, thank you very much indeed as we think about these additional tariffs on the metal space. Kwasi Ampofo, of course, from Bloomberg NEF's metals team. Coming up, the market sell-off continues, of course. We'll get more analysis. Stay with us. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Risk assets tumble as Donald Trump threatens more tariffs on China and confirms levies for Canada and Mexico will go ahead from Tuesday. Beijing says it will take all necessary countermeasures to defend itself. Meeting the UK Prime Minister, President Trump says Britain could avoid tariffs if a trade deal is reached, saying officials are already working on negotiations. Plus, Donald Trump backtracks on calling Ukraine's president a dictator ahead of today's White House meeting with Volodymyr Zelenskiy. So geopolitics is the overhang, as are the tariff risks, of course. Nvidia falling 8.5% by the end of the close yesterday. So concerns about the tech sector as Mag 7 retrenches year to date, with the exception of Meta. US futures are currently pointing to a slightly brighter session, but the context is you saw a loss of 2.7% for the Nasdaq 100 yesterday and a drop of 1.6% for the S&P as well. European futures set for a brutal session, down 1.1% after losses of about 0.5% yesterday. FTSE 100 futures pointing lower by 52 points. We look ahead as well to inflation data out of the US, that key core PCE gauge, and what that could mean for expectations around the Federal Reserve. Let's flip the board and have a look cross assets. The bond bull market continues. Yield down 3 basis points on the US 10-year, closing into 4.2% right now. We saw, of course, and we have seen pretty significant moves into treasuries. Bit of a safe haven move there. Currently 103 on the single currency. The euro back below the 104 level, down 0.1% in the session today. Bitcoin also posting pretty significant losses. Just think about where it was with that record high above 100,000. Now at 79,000, down 5.6% in the session and wiping off about 25% versus those record highs. Brent trading at 73.54, down 0.7% as commodities come under pressure from those renewed tariff threats. So a global sell-off is continuing across equities, but of course you can see that as well in other parts and other assets as investors shun risk bets after President Trump doubled down on those tariffs. Let's get more from Bloomberg's Valerie Teitel on how the markets are adjusting. Val.
Tom, it was a late slide in the equity market yesterday. Some de-risking momentum ahead of the weekend already taking place into the close. We've now seen the S&P 500 flip into the red year to date, so holding on to losses now for 2025. And in the last 5 sessions, in the last week, it's dropped over 4%. Now, a lot of this fuel to this equity slide was driven by tech. Nvidia having one of its worst days since the DeepSeek rout back in January, dropping 8.5% in a late slide as well. A lot of de-risking angst as we look down the barrel of Trump's tariff agenda. That March 4th date really catching people's eye because, Tom, he added yet another tariff threat to that date, an additional 10% on China. That is a new one coming from Trump, which really rattled investors' risk appetite yesterday. And it's rattling the Asia market overnight. The CSI 300, the Nikkei, the Hang Seng, all posting some pretty steep declines. The Nikkei in Japan, that is a 3 standard deviation move to the downside as we look ahead to any retaliatory measures possibly coming out of China.
OK, Bloomberg's Valerie Teitel on the market reaction, and it's pronounced, as we say, pretty remarkable to think about what's happening with Mag 7 and the S&P. Valerie, thank you very much indeed. Let's get back to the tariff story then, and how we should be thinking about the most recent threats from President Trump, saying that 25% tariffs on Canada and Mexico are on track to take effect on March the 4th, Tuesday of next week, of course. He's also set to impose an additional 10% levy on Chinese imports on the same day, with Beijing announcing overnight it will take all necessary countermeasures. The International Trade Center, which supports small businesses in developing countries to trade, has studied the potential impact of tariffs. According to their analysis, if all of the president's tariff threats materialize, global exports to the US could decline by $237 billion. Very pleased to say I'm now joined by the Executive Director of the International Trade Center, Pamela Coke-Hamilton. Pamela, it is difficult. Good morning. Thanks for coming to the studio.
Thank you.
It's difficult to cut through the smoke and mirrors of the tariff threats. Some are real, some are leverage, some are part of a rerouting of trade supplies, it seems. What is your current assumption about what tariffs will come into place and the potential impact?
Okay, I'm hearing the news that they will go ahead on March 2nd. One of the difficulties we have is, as you said, it's smoke and mirrors. So we're not sure when it will occur or if it will occur. But we're assuming that it will occur on March 2nd. The problem is that what has occurred within the context of tariffs is that they're not taking into account the fact that in the supply chain, if you're making a car, intermediate goods, which are 40% of global trade, 40%, cross the Canadian border at least 8 times. Therefore, for every time it crosses, you add 25%. Can you imagine the final cost and the impact, therefore, on trade? And therefore, what is happening is that countries, especially Canada, are beginning to look at shifting their trade with the United States. How will that impact in the long run? In the long run, it will increase costs for the United States. It will make them less competitive, and it will also create instability across the markets. I've seen the fall in the markets taking place already, and we see exactly what the potential is for disruption.
What does that mean for global inflation then?
It's not good. It's going to be a serious problem because we're adding not just Canada, we're adding Mexico, we're adding China, and all three are interconnected in a globalized world. Therefore, increasing tariffs from 10 to 20% on China, plus Canada and Mexico, which are your largest trading partners, will create hyperinflation. And that is going to be an incredibly difficult scenario for other trading arenas, especially developing countries across the world.
Okay, so the risks of hyperinflation as a result of this. What is the ability of these trading nations to reroute those exports, the time frame and other markets they could be shifting to, whether that's Mexico, Canada or China?
Shifting is always going to be difficult because they've set up systems, and the systems will take a while to shift. But I think from the soundings, there's a commitment to do this. It will probably take 4 years to 2029, but the shifting is already taking place. If you look, for example, in 2018 versus now, China's relationship and their deficit with the United States has fallen by 17%, but the increase in that deficit moved to Mexico at 144%. So what has really been saved, And then in addition, when you have a scenario where, the Mexico, Canada, and the United States are tied into what was a free trade agreement, where there would have been normal dispute settlement procedures, that has completely been abrogated. So how do we move forward in a trust situation? I think a lot of this has to do with trust and predictability. And,
Does China have trust and predictability? Is China the beneficiary of this to some extent in terms of its relationships with developing nations? They look to China now as a trustworthy trade partner. Is that potentially another consequence?
It is. As a matter of fact, combining the tariffs and all of that with the withdrawal of the aid has completely shifted how countries are going to view their relationship with the United States and their trust versus their engagement with China. There's always been this, tug of war. But I think what has happened is nature abhors a vacuum. And therefore, if you withdraw, for some places, 50, 60% of their aid, they will turn to the next power. And that's a threat.
On a sector-by-sector basis, you talked about the autos market.
Yes.
Is that kind of near the top of your list as you're thinking about different sectors and how vulnerable those sectors are to these threats?
Yes.
How do you rank that?
I would say autos are huge because of the nature of the supply chain and how it works and the various crossing borders. I think tech is also going to be affected because of the China link, and therefore the increase in prices, and therefore what the impact will be on U.S. consumers. I don't think people understand the level of dependence of the United States on inputs from China and other countries. And I think that will become clearer as we move ahead.
We haven't even talked about retaliation, and China has reminded us that they are prepared to retaliate. The European Union have a list of different products that they're looking to target if it comes to that, and Canada following a similar line as well. We're on the brink of a potential global trade war at this point.
It would seem so.
Yeah.
Yes.
And those retaliatory tariffs, those retaliatory measures, combined with the tariffs that Trump is threatening, and what does that do to global GDP?
Let's put it this way. If there is this massive retaliation taking place, China has already filed in the WTO, and therefore they're following a procedure. But the fact is that procedure, is already, in a sense, stymied by the fact that there's no appellate body that's working.
Yeah.
So, in a sense, the WTO has almost not been able to function effectively. So the retaliatory tariffs across the board with China, with Canada, is going to lead to this amazing trade war that I don't think we've seen ever in this current dispensation. And the impact on developing countries especially is going to be epic because of the fact that there's a huge dependence on the level of imports. And therefore, if you have inflation, if you have rising prices, the ability of these developing countries to function effectively in a global trading market is going to be significantly impacted.
Okay. I think it's fascinating. I mean, one of my key takeaways from you is that the rhetoric already, even as some of these tariffs have not been implemented, we've had those implemented on China, 10%, but it hasn't come through yet for Canada or Mexico or the EU. But the rhetoric alone is leading to a change in terms of how companies, corporates and countries are thinking about rerouting their supply chains, and that's hard to walk back from.
Exactly.
To some extent, the horse has already bolted on that. Pamela, thank you very much indeed for your analysis across how these tariffs could impact the global economy, with particular focus, of course, on developing economies as well. Pamela Coke-Hamilton, Executive Director of the International Trade Centre. Now, some of the stories making news this Friday. EU leaders are to call for increased flexibility in their funding rules to boost defence spending, responding to growing challenges posed by Russia and President Trump. Draft conclusions for a March the 6th summit seen by Bloomberg show that Commission President Ursula von der Leyen is expected to present a letter with funding options. Earlier this week, she called the situation, quote, a once-in-a-generation moment. And Bloomberg has learned that Germany's Chancellor-in-Waiting, Friedrich Merz, and the Social Democrats are set to start exploratory talks on a coalition today. Each side is expected to be represented by 9 negotiators, and Merz has said he will move quickly to form a government. Coming up, talking of Germany, but with a focus on technology, a German AI startup backed by former F1 driver Nico Rosberg has raised $25 million to train industrial robots. We're going to speak to the company's CEO. That's coming up next. This is Bloomberg. Welcome back. OpenAI is rolling out an early version of a long-awaited new artificial intelligence model called GPT 4.5, which is better at picking up subtle cues from its users. Meanwhile, Sereact, a German startup that makes AI software for robots, so staying on the same theme, has raised $25 million to apply its technology, which is software, which it says can be applied on any off-the-shelf robot, essentially to make that robot do things that it hadn't otherwise been programmed to do. Very pleased to say I can bring in Ralf Gulde now, the co-founder and CEO of Sereact. Ralf, thanks for taking the time. Good morning. You come through this raise. How are you going to be deploying the cash?
Thanks so much for having me. So for deploying the cash, of course, 2 things are very important for Sereact. Number 1 is double down on compute. I think for Sereact, we have shown to be very capital efficient, which means at the beginning of time, we bought used gamer GPUs from eBay, building our own GPU servers. But now, of course, it's important to use the opportunity, step up the game, and also use the funds to build larger and more capable models. Of course, the second thing is unlocking the United States. There is no such solutions like ours, and therefore, of course, we want to offer this to North America.
Well, what is the market opportunity then, Ralf, for this segment that you're building out? What are you targeting long term? What's your ambition? How big could this get?
So at Sereact, we build embodied AI that, as you said, can empower all kinds of robots to be a useful tool for humanity. And therefore, of course, Sereact is a company that delivers physical labor. So I think this company, of course, has a market cap that can be a fraction of the GDP. So I think the market opportunity is huge, and especially it can serve our humanity to offload monotonous, boring, and even dangerous tasks to robots.
Ralf, increasingly when we think of robots and we think of the defence spend coming through from Europe as they adjust to the new reality, we think of robotics, we think of defence, and the two come together. Is that a segment that you would look at, potentially, defence technology?
No, not at all. Sereact focuses on use cases like warehouse automation, manufacturing, and in the future, of course, also healthcare and household robotics.
Okay. It's a competitive space, Ralf. A lot of companies out there within the robotics space, within the software robotics space. How do you think about the competition? Are you looking at acquisitions potentially?
We're not currently looking at acquisitions, but I think the competition, of course, is very strong because it's a fundamental problem to solve, to overall increase our productivity. And I think what differentiates Sereact from the competition is that we are building the ChatGPT for robotics. And we have all seen our productivity in the digital world increase orders of magnitude by the use of tools like ChatGPT. I can now translate stuff quicker. I can write code very quick. But I think my productivity or humans' productivity in general in the real world has stayed on the same level. So Sereact building embodied AI, a robotics foundation model that can basically help humanity, our society to push the real world productivity even higher. And I think that differentiates us from other companies.
Is there a place, Ralf, as you sit there in Germany, is there a place for artificial intelligence to be layered on top of the industrial base of Germany to create the growth that Germany so desperately needs? And what do you see that looking like?
That's a very good question. So, in general, of course, we see that artificial intelligence can be a fundamental game changer because it can empower tools like robotics to help us overcome labor shortages and also, of course, reduce our costs. And I think, therefore, it's great to build such a company out of Germany because Germany has tens of years of track record in automation. And now, with Sereact, we're adding embodied AI on top of that to deliver the brains for robots and increase our level of automation. And of course, that can significantly benefit not only Germany, but also Europe and the rest of the world.
Ralf, before we let you go, you've raised that $25 million. How does that position you in terms of fundraising? Do you look to raise again this year? And how are you thinking about IPO plans?
This is, of course, something that I would leave open to the future. In general, I like to keep the company default alive, which means I don't want to make investors happy, but our customers. I want to exceed the expectations of our customers, and then we see what happens.
Okay. A cautious, maybe conservative approach, but exciting times for you in the business. Ralf Gulde, we appreciate it. Co-founder and CEO of Sereact. Customers include the likes of BMW and Daimler, by the way. Well, thank you indeed for the time. Now, some of the news making the headlines this Friday. Bloomberg understanding that investors are pushing fintech Revolut to consider offering another secondary share sale. This is new investors look for ways to get a stake in the fast-growing London-based startup. Some shareholders have indicated they would sell at a valuation of $60 billion, significantly higher than the $45 billion price tag that Revolut garnered in a secondary share sale just 6 months ago. And Meta is said to be in talks with Apollo for a $35 billion financing package to help develop data centers in the US. Sources say the alternative asset manager has discussed providing a major part of the financing. KKR is also understood to be part of the investor group. Meta has already spelled out plans to spend as much as $65 billion on projects tied to AI this year. And Tencent has released its Turbo AI model with a claim that it's faster than DeepSeek's chatbot. The AI service is designed to respond as fast as possible, and Tencent says the deployment cost of the model has also been reduced. The launch underscores the dramatically quickened pace of development since DeepSeek stunned Silicon Valley with its low-cost model a month ago. There's plenty more coming up. We can get more details on the rout in those Mag 7 stocks, with one exception, Meta. That's coming up. This is Bloomberg.
Currently, the data suggests that we are close to achieving that mandate, although inflation has been firmer than I would like and a bit sticky. Certainly, survey measures of inflation expectations are imperfect and subject to noise. But with inflation just recently at a 40-year high, now is not the time to let down our guard.
Kansas City Federal Reserve President Jeff Schmid there. The stickiness of inflation, you can see that here towards the end of this chart. This is the work was done in getting inflation down. You've got PPI as the yellow line, CPI as the blue line, and the white line is PCE, the preferred gauge of the Federal Reserve. So the work was done to pull it down, and here's where we sat, above that 2% level that is being targeted by the Federal Reserve. In fact, between 2 and 3%. On the PPI level, you're at 3.5%. We get PCE later today. The expectation is month on month. It's actually going to tick up. Year on year, you're going to see a bit of cooling, but it's a month-on-month number, particularly around core PCE, that may lead to that concern amongst Fed officials. The counter to that is that the US consumer seems to be slowing in terms of their spend. Fed expectations in terms of rate cuts, markets pricing in just over 2 additional cuts this year so far. That could adjust on the data today. Let's flip the board and have a look at tariffs as well. That ties into the inflation story, even if President Trump says they're not inflationary. The expectation, the view from most economists is that they could be. So here's the breakdown in terms of those potential impacts. We're looking, of course, at Mexico, Canada and China. 25% on Mexico, 25% on Canada, and potentially an additional 10% on China. You're talking about tariffs, if they come into place by March the 4th of next Tuesday, on a total of more than $1 trillion of goods that flow into the US market. Let's flip the board and have a look at the Mag 7, because, my goodness, the rout has been pronounced year to date, except for one company, Meta, which has seen a gain of $103 billion. This takes us back, I believe, to December the 17th. There you go. The pain trade really has been Tesla. A loss of $633 billion US dollars in terms of the market cap of Tesla. The Mag 7 being crushed at this moment. Other than Meta, investing still heavily within, of course, the infrastructure of AI. They have their open source Llama models, and they've seen a market gain of $103 billion within that space. But how much do you want to question the Mag 7 trade going forward? Let's quickly flip the board and have a look at the Asian markets, because that, of course, has been a grim day for the Asian story as a result of the tariffs, as a result of the concern about Nvidia. The downside on HS Tech, look at that, as we come towards the close, down 5.7%, 2.3% drop is what we're looking at across the benchmark in Asia. The Nikkei and the Kospi in South Korea also under pressure. The Kospi being routed down 3.4% over in Korea. Now, on a programming note, don't miss our monthly show, Next Africa. It's airing tonight. Our first episode of the year takes a deeper look into how President Trump's return is rattling that continent. The opening trade, though, is up next. Stay with us. This is Bloomberg.